Hello, today on this video, we're going to discuss a specific scenario for the all-in-one loan for a homeowner who wants to start investing for the first time. In this situation, we would use, I get this call a lot, someone wants to take a HELOC because they want to, they might have a 3% rate, but they want to take a HELOC out so that they can take $100,000 out and put down on an investment. There's all kinds of other products for investments that we'll touch on one of those here in this video, but just the basics of the all-in-one loan. We're the only one with it. We broker it out to some other companies. We service it through our own banks that we own, and it is, I would say, to us in America, it's revolutionary. We took it from Australia. The idea in Australia was it's an interest-only loan with an offset account. For you here, it is a bank account with your mortgage all in one. And it's a 30-year amortized loan, just like any other mortgage. It is variable. It's variable based on the SOFR index, the 30-day average. So February 28th, at midnight, the 30-day average for the SOFR was 4.3%. And then you choose your margin. If you don't want any additional costs, maybe you go with the highest margin, which is 4. So worst case scenario today, you're sitting at an 8.3 when you start the loan. All right. I know there are two different mindsets on this situation in lending all together. There is the cost-based mindset. How much is this going to cost me? And there's the rate-based mindset that's, I just want a low rate. That's all I want. I want to put it on my shelf and tell everybody how low it is and how great my loan is and think I'm getting a great deal. Well, after the simulation, your mind might change. It's not for everybody. If you're living paycheck to paycheck, or if you have a lot of debt and you can't qualify, there's other products to get you there. But this is the ultimate goal, where you want to be. So let's dive into this simulation. In this simulation, we looked at an estimated home value of $800,000. Since it's your primary home, we can do a cash out up to 80%. So we're going to do 640,000 and we're going to compare it to a 6.875. Okay. You're probably thinking, but I have a 3% and I was going to take a HELOC. Well, your HELOC's probably going to be in the 8s. So at the end of the day, you're probably going to be somewhere in the 6s or high 5s. So we'll just, here, you know what? We'll do 6 just for that type of situation. All right. So on here, we're going to say your net deposits. So this bank account is a direct deposit, or it's just regular bank account. You can have your direct deposits, you can run your ACH, your bill pays, debit cards, checks, wire money. It's all just a bank account. And FDIC only insures $250, right? But we're going to have a potential account balance of $640,000. And I'll show you that in a second. Well, what happens? Something happens to the bank. They only insured it for $250. There, you might get $250, right? No, in this situation, that money's secured to an asset because it's a mortgage. It's secured to your property. If anything goes wrong with the bank, that money gets applied to your principal. So you don't have to worry about that whole FDIC insured thing. So let's say you're getting, after taxes and everything, you would direct deposit $12,000 into the account. Again, let's say you had a $300,000 note still on the property that we'd pay off, your 3.5% that you don't want to get rid of, but we're going to pay it off anyway. And so what we'd do, we'd pay that $300,000 off, and it takes 60 days to set up this account. So we're going to wire you the other 340 into your account. And if you have things you want to do, maybe you already see an investment you want to buy, use it, go ahead. But if you don't, you're going to wire that $340,000 back into the account right when it opens, right when you have your logins. Taxes on an $800,000 house, let's just say you're looking at about $450 total. We'll figure high, $450 a month, taxes and insurance. And let's say your leftovers, when we talk about leftovers and we're looking at monthly average expenses, we're not going to include your mortgage because your mortgage is built into the simulation. So when we say what your average monthly expenses are, we're looking for car, student loans, credit cards, anything you have going out, utilities, food budget, gas. So let's go back up a little. Let's just say you have 5,000 a month in expenses going out, aside from your mortgage. Mortgage is built into this. We're going to calculate the results. And based on this situation, if we gave you all 640,000 and you paid off your 300,000 and you had a HELOC sitting there, whether you used it or not, or maybe you did use it and you bought something, you're looking at total expense over 30 years, 1.3 million. Total expense over that 4.7 years is 706,000. This is the beauty of it. We gave you a 6% average rate on your HELOC and home purchase, your original first that you had 3.5, whatever it was. This, we started at 8.3 and you're at 0.671. All right, that's if we didn't make any purchases, but we are doing this scenario for you to start investing. So let's return here to the results for a second. Let's go to rates and assumptions. We're going to, because it's not going to remain at the initial rate. It is going to adjust based on every time they drop the Fed, your 30-day average is going to drop. So you never have to refinance, and this rate keeps dropping as the federal rate comes down. So we're going to change it to a historical average. And now we're going to go spend some money, right? So let's say a year into this, money's been sitting in the account, all right? And you have identified a purchase. And in this situation, maybe we like to do DSCRs because the rate's good. They don't need income. They don't need debt to income. They don't need any of that. We just need credit, down payment, and what it'll rent for. And let's say we need 20% down and it's $100,000. We'll do that on month 12. All right. And then what that does, let's say you on this purchase, just for simplicity, so we don't have to dig too deep into the weeds here. Let's say it pays itself and it yields maybe $250 a month extra in rent. We're going to put that as an extra deposit. And then we're going to go, remember, we just spent $100,000 on month 12. We didn't put it back. So now we're at 6 years and you still have $640,000. And that's what I was saying earlier is you're taking a loan balance, right? We're of 640. We're spending 300,000 to pay off your old loan. We're putting $340,000 back in your account for access. When this is paid off, let's say in 6.1 years, 640,000 is sitting in that account. You could wire it all out immediately if you wanted to. Do whatever you want with it. But it's sitting in there, available. It's paid off. You have no payments. You have a $40 annual fee for the account. No payments unless you take money out. So again, we went and bought a rental property for $100,000 down, and everything's still paid back in 6.1 years. Let's look at this pay down table. Here's month 2 where we put the money back in. Month 12, we took the money out. We spent $100,000. See it increasing? So any given time, let's say not even 1 year and you're already back to that 340,000 mark. So you could technically buy one every 8 to 12 months with 100,000 down. And if we did it on DSCR, you'd never have to qualify with taxes or income or anything like that. That's a whole nother video. Okay, let's go back to the pay down summary. Remember, we were at 0.6. Well, now we're at 0.846. It's starting to creep up because we're paying longer. We spent another $100,000. We didn't get to spend another $100,000 on this other loan. So let's go back and do it again. We're going to spend another $100,000 in month 24. And then in deposits, we're going to add another deposit. $250 monthly. Calculate results. So now we're at 7.8 years. So we added less than 2 years to the payoff. 8 years down the road, you're going to have $640,000 in your account, and you're going to have 2 rental properties in your possession, paying you net $500 a month and paying off the note themselves. Looking at the pay down summary, we're up to 1.154. Okay, we are still at a ridiculously low rate. And then let's go back here again. Let's just to round this out, we're going to do one more because that's all it'll let me. I hope they, on the new version, they give us way more leeway to get soup. But then for me, I get complicated. We can really get in the weeds. So let's just say we do that one on year 3. So within 3 years, you own 3 different rental properties and your current home. We're going back to deposits. Put in a repeat deposit of $250 monthly. Save and close. Calculate those results again. So now we're at 9.3 years. So we went another year and a half. Okay, 1.5 years to pay that $100,000 back. So less than 10 years, you're gonna have all that money sitting in your account, no mortgages, because your other rentals, your 3 rentals are paying themselves and giving you an extra $750 a month. Pay down summary, over that 10 years, you're still never even coming close to the 2%, which you would never see again. So this is how you would get ahead, build wealth, and take advantage of the system. Because if you have your money direct depositing in this account, you could, or you could have your other account and just transfer money each month. But the way this benefits you, because it calculates nightly, is let's say your $500 family cell phone bill comes out on the 15th. If you only transferred money in once a month, you're not taking advantage of having that $500 sit in the account for 15 days, decreasing your interest until it went out. Okay. So there's several ways or several scenarios. If you have specific scenarios, especially in this investment side of it, maybe you're not a new investor, maybe you have investments, you can have 3 of these. Goal is to build out the biggest equity lines you can. So you could do 3 loans, all can do a maximum of $3 million loan amounts. So you could totally get up to $9 million, and just imagine what you could do with $9 million liquid that you can wire out that is secured to assets, not just bank insured. So reach out to me if you have any questions or want to run a specific scenario. But if you have money left over each month and you're not living paycheck to paycheck, there is a scenario that all-in-one makes way more sense than even sitting with your 2.5 to 3% loan. So reach out and we'll talk then.